So, Fed head Ben Bernanke told Congress he's not creating any new money supply. Is it fact or fiction? We got a powerhouse group here. Joe Livornia, chief U.S. economist, Deutsche Bank. Vincent Reinhart, former director of the Fed's Board of Monetary Affairs, Fed's Board Division of Monetary Affairs. He's currently a scholar at AEI in Washington. And on the phone, Art Laffer of Laffer Investments, co-author of The End of Prosperity, out in the wilds of San Diego. Arthur, I want to go to you first because you have been campaigning for quite some time on the need to expand the money supply, which you regard as a good thing. And while you're talking, we're going to put two charts up on the full screen. The first one is the Fed's balance sheet, which is growing at a 25% rate, and the second one is M1, which is growing at a 13% rate. There it is. When Bernanke told Ryan he wasn't expanding the money supply, Art, what in God's name was Bernanke talking about?
I'm not really sure, Larry, but as you know, the Fed controls the monetary base, which is part of the Fed's balance sheet, and the monetary base has been growing at an incredibly rapid pace. Thank goodness, because that's why we had the liquidity crisis. That was why we had the financial meltdown. But if you look at the monetary base, Larry, which is currency in circulation, member bank deposits at the Fed, and vault cash, that number is the key to providing liquidity to the system, and that is the key to allowing banks to increase deposits, which is what's happening with M1. It's wonderful. It's long been overdue, but it's there, thank goodness.
Vincent Reinhart, how can you reconcile? I want to give Bernanke the benefit of the doubt here and not say that he's contradicting himself, but can you think of a way to explain his comments and the fine charts that Larry Kudlow has put together tonight for us?
So I think there's three issues. One is broader definitions of money like M2 haven't increased as much. That is, the money multiplier has gone down some. Number two, he was really trying to get at the heart of the question that said the increase in the Federal Reserve's balance sheet really isn't inflationary. The problem isn't inflation right now.
Well, I agree, Vince, it's not inflationary, but the reason the big M's, you know this, M2 and all the rest of them is because of the run on money market funds. That's the only reason.
No, that's exactly right. The third point is I don't think they have the governance and the communication structure in place for this new policy regime. We're still coming into the FOMC meeting thinking, oh, what is the FOMC going to set as the intended federal funds rate? Guess what? It doesn't matter. When you're increasing the amount of reserves as much, the funds rate is going down to the deposit rate. What the FOMC announces as its intended rate doesn't matter much. What we want to know is how much reserves go up.
Larry, that's right.
Yeah, Joe Livornia, let me just ask you. Hang on, Joe. Sure. First of all, the balance sheet is growing. Second of all, money supply is growing. Third of all, Art Laffer says it's a good thing that that's happening. I happen to agree with him. And last, Vince makes a good point. We're in the era of quantitative easing, and the Fed funds target doesn't hardly matter. In fact, the Fed funds target traded around 50 basis points today.
But that's everything that's been said, I agree with it. I've disagreed a lot with Art in the past, but he's exactly right. Over the last 12 months, the monetary base is up 86%. We have never seen anything like that, and the Fed is not sterilizing its balance sheet. In the last 8 weeks, the assets have grown about $200 billion more than the liabilities. Over the last month, the Fed effective rate has traded 35 basis points below the target rate. Tomorrow will be below the target rate again 7 straight days, so they're not sterilizing. And it's obvious what they're doing. They're pumping in liquidity because they're deathly afraid that LIBOR was going to continue to reset higher. And
this is good, Melissa. This is, we need to crank up the cash.
Yes, absolutely. You see the result. You see the result in the credit market.
I mean, we might have an economic recovery in my lifetime.
Larry, if the Fed tightens, that'll be the best possible thing if the Fed tightens.
If the what? If the Fed tightens?
Yes, when the Fed tightens. Not next week. Not in the next 6 months.
What are you talking
about? I'm saying about tightening late next year, 2010. If they actually got to that point, it would by default mean they got the credit markets working again, the lending channel working, and they take that emergency 1% rate up and put it back where it's supposed to be.
Art Laffer, it seems way too early to talk about tightening at this point.
It is. It's like the person who's drowning worrying about whether his canteen is filled for the trip to the desert next month. But honestly, honestly, this is the problem, is the Fed has not done this for 2 years, and that's why we've had a credit crunch. We've had an excess demand for money, which finally caused caused the panic, and that's what made them finally do the right thing. It's tragic because now we have all these terrible bailout things.
But Art, I thought we had too much liquidity. It was too much lending. It was too easy lending standards. How could you say there wasn't enough liquidity?
The last year, year and a half, 2 years, the monetary base has grown literally zippo.
Well, how was it there was so much securitization, Art?
Let's put up, wait a second. Let's put the monetary base chart back up on the full screen.
Please do.
What Arthur is saying is factually correct. This is why Bernanke, who I generally admire and respect, he was, after all, one of only 3 non-socialists on the Princeton Economics Department faculty. So I've always given him credit for being a non-socialist.
The other 2 were in physical education.
No, Burt Malkiel was the other one, and the other one passed away. But let's not go there. See, Art's right. Look at that. 2007, flat on its tuchus. Look at the first half of 2008,
Larry,
flat on its keister.
The base has 0 correlation with GDP, both nominal and real, over the last 40 years. Show that chart.
Hey, Vince Reinhardt, can I move on? Because I think we have total agreement here. Vince, Mr. Paulson says today that the banks will deploy and not hoard the new government capital. Now, this is a very important debate unto itself, Vince. Weigh in for us. Do you agree with his statement today?
I don't think there's any mechanism in place that makes it so, but I think the fact that if the Fed keeps pumping in liquidity, short rates stay low for a long time, they will, by market forces, want to deploy that capital.
Joe, do you agree with that? Because it seemed like we started getting some notions from John Mack, the CEO of Morgan Stanley, last week when he was on the sidelines of the Business Council meeting in Kiowa Island, that the first order of business is to improve leverage ratios as opposed to starting to lend this liquidity out.
I completely agree with Vince. That's exactly right, Melissa. And the terms in which these banks are getting money is not onerous. And by backstopping new lending for 3 years, that's the whole intention, is to get the lending flowing, and it's going to start. But if we look at where LIBOR is supposed to set tomorrow, it should be 20 basis points lower. It's down about 80 basis points from where it is last week. So the market is getting that flow of liquidity. All
right, that's good. So there is bank-to-bank lending, as was reported over the weekend. But Art Laffer, let me go back to Melissa's point. Banks are worried about leverage ratios, and if the government is giving the bank money at 5%, Art, and they have debt between 7, 8, 9, and 10%, won't they use the cheap money to retire some of their more expensive debt? Wouldn't that actually be prudent for shareholders?
Sure, of course it would. In fact, one of the problems is, Larry, they didn't have enough capital. And one of the things would be building up their capital base there to make sure that they have enough capital per unit liability. And that's exactly what they should do. Part of it goes into building up reserves, and part of it does new business. That's natural, and you do it right on the margin. But what really is the problem is the government involvement in the banks. That's really a long-run problem.
I fundamentally disagree with that, Art. You wanted Fannie and Freddie to go under, and we would have been in Armageddon.
Let me tell you, when you bail someone out of trouble, you're putting someone else into trouble, plus you got a toll for the troll, and we're going to live with the taxes that this operation has done. It's worse than anything Nixon did.
Art, as you know, the financial system is different than any other industry.
I know, but I've lived through these things, and I've watched them. When people make decisions when they're panicked or drunk, don't worry about the consequences.
You know, Vince
you weren't
Reinhardt,
around in the 30s.
All right, hang on a second. Vince Reinhardt.
Unfortunately, I was.
I can't figure out, Vince, what to do, what the government, what the Treasury with Fannie and Freddie. In other words, they won't fish and they won't cut bait. If you want activist Fannie and Freddie, Vince, to buy up the mortgages, then you got to put a lot of capital into them, which they haven't done. On the other hand, if you don't want them to be activists, then let's put them out of their misery and just sell them out into the private sector.
The shame is to do the right thing isn't the right time. And you take advantage of the fact you own Fannie and Freddie right now. Start buying back mortgages. They had this authority for 2 months. They should have been doing it all along.
That's exactly right. Get those mortgage rates down.
That's what the candidates are saying, by the way. In effect, they're not as articulate as Vince Reinhardt.
No,
but
not
really,
at all.
what McCain and Obama essentially want, and I think what will happen, is Fannie and Freddie re-securitizes the mortgages at more comfortable terms. I think that's coming.
You heard it right here.